Good day, everyone, and welcome to JK Michael's Knowledge Series. Welcome again. Today, we're going to be asking a very important question. What is your financial credibility score? Well, credibility, credit, in this case, we use it for credibility with this topic, but we're going to be talking, as you suspect, credit scores, right? The last time we spoke, we talked about your net worth as a matching of your assets against your liabilities to be able to see how much excess assets you have over your liabilities, and how we can be able to improve our asset to liability ratio. Because when we improve the ratio of our assets to liabilities, we'll be able to improve our financial health, our net worth, our general financial standing. Now, apart from the computation of your net worth, there's also another important indicator of your financial health, and that will be your credit score. Now, what does it mean? Now, we've spoken about asset matched against debt or liability, but then again, what is even your habits, your tendencies? How do you manage, or how responsibly do you manage debt? So we're going to look at what the credit score is, what does it mean for you, and how can you be able to how can you assess it? Now, let's examine what a credit score is and your credit report. Now, every time we need access to credit, if we need to take loans, if we need to take on debt, right? The people who are responsible for providing us with these credit assets will want to look at some history, something that tells them that we are likely to pay back the loan we take. So lenders generally will review your credit report and credit score before they approve loans. And then your numbers or your credit score will influence whether you get approved or not, will influence whether you get huge interest rates or lower interest rates, will influence the terms of your payment. The credit report, on the other hand, will contain things like identification information of the person, the credit account history, opening date, the balances, your payment history. And if you have any bankruptcy record or any credit inquiries, it will also capture it. Now, what is a credit score? Very simple. A three-digit number that will be culminated from your credit report or all the activities in your credit report. It will predict the tendencies or the likelihood or the probability that if you take a loan, you are going to default or not default. So what it does is, what's your probability of defaulting with the loans you take, right? Now, please note that it is different from the credit report, right? Most of the times, if not all the times, this three-digit number is going to be priced, given to you and priced separately from the credit report, which will carry your whole credit management history or your credit management activity. There's also what you call the FICO credit score, developed by Fair, Isaac and Company, and it has a range of scores between 300 to 850. And if you score on the higher end or towards the higher end, then you have lower risk of default. If you score towards the lower end, between 300 to around 600, then you have a higher risk of default. So generally, people want to see, or people want to give easy access to loans with better terms and interest rates to people who are on the higher end, between 750 down to 850. Higher scores, like I say, indicate lower risk of default. It's widely used by lenders despite alternative credit bureau specific scores. Now, what is the impact of having credit scores or having a good or a bad credit score? Well, higher scores will qualify you for better loans, for more loans with better loan terms, lower interest rates, right? So that's the reason why you want to maintain this. Lower scores are almost a credibility thing, indicate higher risk of delinquency, and would close up your access to credit. The median score is around 720. It's always better to aim for 750 and above, right? Now, how do we assess our credit report? Generally, once every year, you are entitled to one free credit report from each of these bureaus. These are the credit bureaus, right? Equifax, Experian, and TransUnion is available via what? Annualcreditreport.com or by phone. And of course, the reports that you'd get may differ across the bureaus. You want to review all three and make sure that you correct errors if you happen to find any errors. So you review it with the aim of ensuring that errors in the credit reports are corrected. Now, moving on, we have credit scores and cost. Well, free annual reports do not include credit scores. So if you need your credit score, you will purchase them separately. You want to be careful about buying credit scores. If you buy from credit bureaus, it's cheaper than buying from the original Fair Isaacs, right? So you might want to aim for credit bureaus, right? And purchase your credit scores from them rather than from Fair Isaac. Be cautious of credit bundling, monitoring subscriptions, anything that is above and beyond. Look at the terms and payment. Anything that is above and beyond delivering you your credit report or your credit score, then you might want to carefully see what else is being sold to you, or what else is being taken from you, what kind of information. You want to review all your credit reports. When you get a credit report, please check for errors. Errors should be disputed and corrected promptly through the reporting bureau. And why is this very important? Because your credit information is an extension of your life, is your reputation, is your financial credibility. So make sure that you guard it, make sure that you protect it with your life. Now, moving on, we have in the Nigerian context, how do we check credit score? Well, not very much different from in other contexts, right? But basically, let's look at this, right? Your credit score is going to be categorized as excellent, good, average, fair, or poor, right? Anything 720 and above is excellent. So people will put the mark at 750, and then 690 to 719 is good. 730 to 630 to 689 is average. 550 to 620 is fair, and then 300 to 540 is poor. Right? If you get your credit score, then you're going to see this range of numbers. For instance, let me read out what a credit score, right, information I have here, right, and that uses a slightly different rating, and this comes from the CRC score, right, powered by FICO. Just a minute. CRC Credit Bureau, right, powered by FICO. Now let's read this out. So we have 300 to 400 being poor. I'm reading out from information from a CRC credit bureau score that I generated, my own personal score, right? 300 to 499 is poor. Lenders may perceive individuals with such scores as having a history of missed payments, significant debt problems, and other financial difficulty. As a result, these individuals may find it challenging to qualify for credit cards, loans, or favorable interest rates. It suggests a high risk of defaulting on loans or credit obligation. A score of 500 to 649 is average. For lenders, this range suggests moderate to high risk. While individuals with this credit score may still be eligible for some types of credit, they are likely to face challenges in obtaining loans or credit cards with favorable terms, such as lower interest rates or higher credit limits. 650 to 749, good. To lenders, a credit score in this range suggests that the individual is less risky compared to those with lower scores, and they are likely to qualify for a variety of loans and credit cards with favorable terms, such as lower interest rates and higher credit limits. Lenders may offer competitive deals and may require less documentation or security. And of course, we have 750 to 850, which is excellent. For lenders, a credit score in this range, it signifies a low-risk borrower. These individuals are highly likely to qualify for best interest rates and terms on loans and credit cards. They may have access to higher credit limits and premium financial products, such as exclusive credit card offers and preferential mortgage rates, right? So this is actually a snapshot of an actual credit credit score. My own credit score, it was provided with the ranges. Now, how do we use this? Well, the uses of credit scores is for credit evaluation. So who do we give credit? Before we decide who to give credit, we want to know the credit worthiness of these individuals. Customer pre-qualification, especially if we have to give loans to customers, if we have to allow them to take some form of credit in the form of receivables, then we want to know their credit history. Market expansion by lenders. When lenders want to get into new markets, then they want to know the nature, the characteristics of that market. Now we have good versus bad credit scores. A good credit score would be generally defined by timely repayment history. Now, what do we mean by timely repayment history? Well, you want to ensure that when you take a loan, right, you pay back on time. So it's not necessary. Now, if you take a time based loan, let's say you take a loan for 1 year. Let's say you take a loan for 1 year, then and you're expected to make payments within certain months, then the fact that you make those payments at the time specified is means that what you have a timely repayment history, not paying out all of them, but what is due should be paid as soon as it is due. If you can even pay it earlier, then it's significantly better. Responsible loan usage, you want to make sure that loan is what? Used responsibly. If you collect a loan for a particular thing, make sure that you utilize that loan for what it was collected for, especially when the loans are tagged to specific kinds of utilization, right? Or also, if we collect loans, we want to make sure that we are collecting loans for investments rather than for consumer consumption. So that's a responsible way to use loans. And then again, we also have the timing and payment behavior is another aspect to responsible usage of loan. And then credit utilization being lower than 30%. Now, what is credit utilization? Well, credit utilization is the percentage of your available credits that you are currently using. Now, so if you have a total credit limit of 100 and the total credit you're using is about 30, then we have what? 30 over 100 multiplied by what? 100%, which would be 30%. So you want your credit utilization any point in time to be lower than 30%. It's an important factor in determining credit score. Low utilization, generally below 30%, is generally viewed as positive, right, to lenders. High utilization can indicate what? Financial troubles and higher risk of default and can lower your credit score. It applies mainly to revolving credit. So if you have credit card, now what revolving credit actually is let's assume you take a debt of, let us say, 100,000. And for you to be able to access more debts, right, you need to pay 20% of the debts. That's the minimum you need to pay. So you keep using 100,000 debts, and then the moment you pay off 20,000, then with 80,000 left, then you have access to more loan. This is what you call revolving credit. But it can be quite dangerous. You want to make sure that you don't keep these numbers high, right? The revolving credit, you don't actively use them to exhaust your credit utilization score and have very high balances in these types of credit accounts, right? Okay, now a bad credit score is generally a credit score below 630, and what it means is that you have a higher risk of default. Now, moving on, we have who can access your credit report? Well, generally, any individual or any institution that has a responsibility to protect others or to protect itself from poor quality financial decisions with you, or poor quality financial decisions in a relationship with you, can access your credit report. So generally, the people who grant applications for loan and guarantors might want to protect themselves by knowing your credit score. Lenders and credit monitoring entities protect both themselves and other people. Employers need to protect themselves, right? And prospective landlords may need to protect themselves to know your borrowing history and your repayment patterns. Insurance companies may need to protect themselves. Debt recovery and enforcement entities, well, they would naturally need to know your credit history, right, and your credit report. Regulators and courts, a very huge amount of litigations happen around what? Financial obligations. So yes, regulators and courts will be expected to assess your credit report, and then entities that are conducting know your customer for any permissible purpose, know your customer KYC, would be expected to have access to your credit report. Now, institutions with access to credit score, banks and financial institutions have or should have your credit scores. Leasing and insurance companies should be able to access it easily. Cooperative societies and SME lenders, utility companies, asset management companies, postpaid and installment-based service providers, and then, of course, the Central Bank of Nigeria. Now, what is the impact of this on loan application? Well, credit scores significantly will increase or influence what? Approval decisions. If you have good or higher credit scores, then you will get more loans approved, higher credit limits, lower interest rates, and generally more favorable terms, right? So strong credit scores will improve your access to financial products. Very important to improve your credit reports and score. Focus on improving it rather than paying for score monitoring services. Improving credit is important, especially if you see that your reports came with what? Negative information. Now, how do we improve our credit? Well, number one, obtain all three credit reports. Like I said, there are three major credit reporting bureaus or agencies. You want to make sure that you have from all three. You want to verify the accuracy of each report. Anything can happen. Information might be misrepresented. The wrong information might be sent. Omission, simple omissions can significantly affect the quality of a credit report. So make sure that there is accuracy in the report. And if you find any errors, especially accounts not belonging to you being included in the credit report, or accounts that you do not even recognize, they neither belong to you or you are expected to be in debt to these organizations, then you want to ensure that you request a removal of them, right? Request removal of late payments or missed payments older than 7 years. So if there are payments that should have been made late or missed, but it's more than 7 years, make sure that it is taken off, right? Bankruptcies older than 10 years should also be cleaned off the records. Pay all bills on time. Every obligation, financial obligation, should be made on time. If you need to use automated or automatic bill payment systems to ensure that the payments go out without your prompting, then go ahead and do it. Avoid late payments at all costs. Maintain older credit accounts where cost effective, right? So if there are people you collect loans from or you collect credit from, then it might be better to maintain your relationship with these ones or with these individuals, with this institution. Loyalty pays. Avoid unnecessary closing of old accounts. Refinance or transfer balances if it reduces costs. Limit the number of debt accounts. Don't have too many accounts that carry debt figures, right? Debt information. You don't want to have a lot. You have with Access Bank, you have with Diamond Bank, you have with Guaranty Trust Bank, you have with Union Bank, you have with Fair Money, you have with REM Money. That's too much, right? Reduce your outstanding balances, especially what revolving customer debt. I've spoken about revolving customer debt as a debt account that allows you to be able to take more credit if you pay a minimum amount. I said that with respect to taking a loan of 100,000, paying 80,000 or paying 20,000 as the minimum limit and giving you access to more loans. Where it can be a trap. It might not have been intended as a trap, but can eventually become a trap for you, right? If you don't have disciplined credit management behavior. Make sure that you reduce your outstanding balances, or especially revolving consumer debt. Now we have getting credit report errors corrected. Now, if you have credit reports, like we said, you want to review them and make sure that the information is accurate. Credit bureaus and creditors frequently make errors. Make sure that you follow a formal correction process. Now, what are the different types and how do we correct them? Errors can be caused by another person's information. If you find another person's information, another person's account numbers attached to your BVN or your financial identity, or you find a different organization, an organization that you've never dealt with respects to debt or credit, you want to contact the credit bureau and you want to request clarification for unfamiliar accounts or creditors. I don't know these creditors, I've never dealt with them, right? Errors can be caused by a creditor. The creditor might send the wrong information to the credit bureau. Contact the creditor directly and request correction of inaccurate information, right? And the inaccurate information that was sent to the credit bureau. Now, if the creditor made a mistake, you want to contact the creditor, right, to correct the information sent to the credit bureau. You can start with a phone call and follow up in writing if necessary. Obtain and record names, contact details, and commitments of representatives, right? Every detail that is supposed to be evidential and helps to be able to rectify that error should be kept and maintained. Follow up if promised corrections are not made. Escalate issues to the department manager of the creditor, in this case, like a bank or a loaning agency or financial institution. Credit bureaus are legally required to respond to correction requests within 30 days. Now, on the other hand, if there are minor credit issues that are not resolved or need some form of explanation, or credit bureaus are required to allow a 100-word consumer explanation to be added to your credit file if disputes remain unresolved. And this allows you to tell your side of the story, right? Some lenders would generally want to see your side of the story, want to know, okay, yes, there was an issue here. What was the nature of this issue, right? So legally, you are allowed to have space, a 100-worded space to explain issues or slight or minor credit issues, right, if disputes are not resolved. Now, as much as possible, if there are errors in your credit, make sure that you do it yourself. I want you to avoid credit repair firms, quote unquote. Credit repair companies a lot of times overpromise, underdeliver, but this will even come with what? Excessive what? Fees. Legitimate credit reports, the correct, the right ones generated by credit bureaus, right, would generally be corrected or errors erased by the individual who has that report. It's very difficult or even impossible to correct credit report errors by third parties, right? So individuals can correct valid credit report errors themselves without the use of paid services. And this is very important. If you find that there's an error, pick up your phone, call the creditors, call the credit bureau, get it resolved. You don't need to pay anybody to do that for you. The costs will not tally with the benefits you're going to get from that. And thank you very much for listening. When we come back, we're going to look at debt as a financial management tool. We've spoken about debt as a part of your financial position, right? As it influences your financial position, which will be your net worth. We've spoken about debt as it impacts your reputation, which would be your credit score, which will be your credit score and your credit report. But the next thing we're going to look at is debt as a financial management tool. And I'll see you in the next video. Thank you very much.